I only have 6 slides, so I'll see if I can go through them a little faster. There may well be interesting questions following particularly Colin's and Ted's remarks. Maybe follow up on his final points there. Just give you a quick overview of the industry I come from, and which certainly affects what kind of perspectives that I take to trade issues. The pork sector, or the hog sector, is about $4 billion at the farm level, a little bit less. And in my own projection for 2012 is that we'll have exported about $3.5 billion of pork and pork products. If you add in the live exports, probably very close to $4 billion of exports from our sector. And that includes that. So now we've become quite a bit more diversified in our exports, and at one time we wanted to move away from dependence on the U.S. market because of the exposure to trade actions. We had trade actions in the mid 80s and early 90s, and again in 2000. And it wasn't just since the U.S. dollar climbed. It's the last, probably decade and a half. The U.S. pork industry has been a pretty dynamic one, and has become itself the largest pork exporter in the world, and is in pretty sound shape to hold on to that market share, maybe even increase it. And so we have moved from being 2/3. In fact, I think at one point we were, when Japanese exports were lagging some years, we would be 80-85% dependent on the U.S. market. So that benchmark there of 20 years ago being 65% to the U.S. would not be the high point, but it would have been typical of that period. Now we're down to 30%. I think we've slipped under that a couple of times in recent years. So about 2/3, probably even 70% of our the pigs born in Canada, the product of that, whether it's as live animals or as meat, would be destined for export markets to well over 100 countries, although take our top 10 and you're getting over 90% of it. As in most ag sectors, we've had a tremendous downsizing of the industry in terms of hog producer numbers. Production, though, and during that time has probably certainly more than doubled. And so we've seen, though, essentially 10% of the producers today, as there were back at the time of the Montreal Olympics. This is a little bit off the topic of emerging markets, but it is something that is really causing us to focus on trade agreements and our export opportunities. And I kind of look at this as being in moving into the post-MFN era. We no longer benefit, or we no longer can rely on the results of the MFN process, where some of the heavy lifting is done by bigger exporters and importers, such that everybody gets the same import access conditions that those 2 or 3 or 4 negotiate. And I think Canada did very well over the years with that system. Certainly we were very engaged in the negotiations, but we did get a lot of fallout from the MFN tariffs that were achieved, and often we're able to maintain things within our own country that we would prefer not to have to negotiate, put on the table. Of course, that has changed now with having to look more at a bilateral system. But this is the situation for our terms of our access to South Korea. This is for one tariff line, frozen pork other, for which we exported in 2011 $137 million of product. And that was a good chunk of our total exports that year, which were about $250 million. And there you can see in 2011 there, we were at no disadvantage to the U.S. in terms of tariff. Now, Chile has had a free trade agreement. Everybody else was looking at them at WTO. Chile was putting together a whole bunch of trade deals. So already by then they had an 18% advantage, but of course they don't have the volume to take over the market by themselves. And Europe had just started to put their FTA into place. So 2011, when we put out that kind of exports, those are our tariff disadvantages. This year, now, with the U.S. already moving 2 tranches, so they have a 13% tariff advantage over us. Chile is almost a totally free access, and Europe has a 10% advantage. And then in 2 years, this is the situation. Well, we're already pretty much out this year. We may have some trimmings. Just from last year to this year is just enough to. There's just not enough there to stay in that market. And I think, Ted, your company is. I don't know whether they're going to maintain an office in Korea or not. It's just impossible to maintain anything like that. In fact, it'll be, I think, at best $30 or $40 million by this year or next. So this is a major example. There's not all examples like that, but it just shows you where the old MFN rate of 25% is irrelevant to these three exporters. Totally irrelevant. It's all now being determined by their terms of free trade access. So we have to look elsewhere, and this is not just because of Korea, but when we negotiated CUSTA back in the 80s, it was very much about getting securing access to a market that we really worried day and night about something coming up, border inspection, whatever it might be, that we would be out of that market. And so we were very fixated on the U.S. Now, it was around that time that we were starting to get exposed to trade actions, which caused us to have to think a little bit more than just shipping into the U.S. market, but still we were quite oriented to it. And here's an example, I guess, where kind of the emerging market thing comes into play was when the U.S. started to talk to Mexico about a free trade deal. And our initial reaction, I recall, was we were a little bit hesitant about engaging in changing our trade deal with the U.S. to accommodate Mexico, and we worried about losing some of our advantages and so on, until it really dawned on us, I guess, that here was this spoken wheel system that we better get into those talks or we're going to find ourselves having secondary access to the U.S. So indeed, we got into NAFTA. Now, as we know, and I think as Colin has really pointed out very, very well, is that U.S. is not the engine for Canadian economic growth, and the same thing applies for our sector, the hog and pork sector. So thus, we have a major interest in our current trade negotiations agenda, and we are very engaged in all of those negotiations in that order, in terms of the potential for them to be complete. Although, I don't know, these two, maybe they'll kind of be in similar, like, few years. Well, TPP should maybe move up, but in any case, TPP is the one that brings us into much more of an exposure to emerging markets. So, emerging markets are certainly different. If we put them all together into one basket, there's some major differences between dealing with these countries versus our traditional markets, such as the U.S. and Australia and so on. These countries do have, as a fairly common characteristic, very rapid per capita income growth, not just total growth, but per capita wise. And the tendency is that when people's per capita income does increase, people do spend more of their food. A bigger part of their food expenditure goes towards protein and particularly animal products. And a lot of these emerging markets have joined WTO and are in various degrees of transition, adopting the WTO codes. There's a more of a dependable third-party dispute settlement system available, and moving, of course, to bound tariffs. Now, for us to have efficient scale of not only processing plants but production farms, we really do need this much larger access that's available to us by a range of world markets. The Canadian domestic market itself is not enough to keep more than one, maybe two world-scale pork processing plants going. It's pretty hard to have that in effect without regulated pricing if you're going to have competitive prices being offered to farmers. So we really, in order to have to sustain the growth, to sustain the investment in larger processing plants, we really do need this wider selection of export market opportunities, and they must include much more than just the U.S. and other developed countries. Also, and I think as Ted has really pointed out here, and I think John was referring to these yesterday, this variety of export markets they're not homogeneous. They're all different in terms of what particular products they're looking to import, and it has. If we look today at what we get for some of the byproducts that used to be, some of it went into pet food manufacturing, now it's going into countries like China where the value of them is greater than some of our primal cuts like hams. So it does gives us that opportunity to find these many individual high revenue returns. Now moving into the challenges. So there's opportunities, but there's also challenges as you move into this sort of market. And there's definitely different rates of acceptance, transition to the WTO system from many of these markets. Particularly the bigger the country, the less quick they seem to be to move to some of these WTO characteristics, such as notifying the WTO Secretariat of a change in a regulation that would affect imports. Sometimes it's done first and then there's a little consultation afterwards, as opposed to notifying and then giving time for consultation. So these kinds of things we are used to dealing with some of these things in a much more transparent manner than is the case sometimes with emerging markets. But I'll just point in there a little smaller characters, but we certainly aren't perfect either. We don't use every codex standard in the book. But we do look to increasing use of these international bodies. There's also a tendency for these countries in the early parts of their development to not really be embracing the idea that, okay, we can import these things more cheaply than we can produce them, and then we'll be using those resources to produce more of the things that we can do more cheaply than others. It's really, usually with food being so politically sensitive, they tend to import what they can't produce. And that varies from year to year enormously, particularly in countries like the size of China and Russia. And so you do have really important growth in those markets, but it's anything but smooth. It's highly variable. So you need a few of those markets that together give you a total market. So, I mean, a couple of years ago, I think it was the Chinese market that kind of saved our export business. Last year, it was Russia. And, but as always, China doesn't like to import pork, for example, because people think, well, that's something, we always produce pork in China. And so there is a sensitivity there that emerging markets tend to deal with in their early years of opening up to foreign suppliers. And we also see, not only do we see a new increasing important markets emerging with these countries, growing with these countries, we also have new competitors. And in the last few years, we've seen Brazil, Chile, and very, very, very good, well-run industries in those countries. And so my final slide is that we really simply, just in order to maintain the business that keeps a viable, healthy industry that needs to or is motivated to reinvest, we need to definitely get into the game. We need to be able to export to these emerging countries with trade agreements, certainly with help. But I think, as Ted has implied, you need also to be looking at your marketing and your approach to your sales. And one needs to be patient here. I think just the example here, I think it was 79, maybe it was 78, South Korea allowed a certain amount of product to come in. Canada was able to do that. And then it sort of virtually was shut to us for decade and a half. During the period of the Uruguay round negotiations, there was certainly an opening up in the Korean mind to the idea of allowing imports. And now, of course, it's become a major import market. So one can't expect this to happen overnight. And certainly over time, countries do see it in their self-interest to allow themselves to import more. There is a political hurdle to be reached, but I think England did it back in the 18th century, but since then we've seen, Japan did it in the 50s, into the 60s, and then South Korea in the 90s. And I don't have it on the slide, but as these countries move from less developed, developing into more developed, and now like Korea now is a member of OECD, the opportunities for value adding also correspondingly increase. And if one is ready to exploit it, and as Ted says, Ted suggests it's not automatic. And these food importing countries don't let themselves rely on one. They really are in a position where they can really play off all the suppliers, and really take advantage of the opportunity to get the best deal out there. But certainly, Canada needs to be one of those alternative suppliers that these emerging countries can access from. So on that, I'll close. Thank you.